Good morning. Oh my gosh. Did you get excited when you looked out your window, or did you get down? Like, did you get all frumpy and like it's too cold outside, or like really excited that this is the first snow of the season? I got excited because I live in Denver. Did you get excited because you already had a foot of snow?
Well, yeah. So I had about an inch of snow already when I woke up this morning, and I was just out of sorts because it was so dark in my room.
Yes.
It's like, am I supposed to be up right now? This feels so dark outside, and it was just dark. And so I'm a summer lover. I am not loving this.
Yes, no, I know. And I
I'm not
said
loving
a
this.
foot in jest. It's already snowing. It's a lot. All right. So we're going to start off with our quote. We're going to jump in. There's plenty to talk about. GDP numbers came out this morning, and oh my, why did the markets like it so much? And what's happening with interest rates? And we're going to talk about several loan programs that you need to make sure that your buyers know about in this strategy season, especially against, in favor of opportunity. But here's where I'm going to start the quote. So it's from Helen Keller, and it is, "Alone we can do so little, together we can do so much." And I have to admit, like, this time has been amazing over the last couple of years. What I know I've learned from Megan and what I hope she's learned from me. Did you learn anything from me?
I've learned a lot from you. A lot from you, definitely.
So what we've learned from each other, what we've been able to share, the hours that we've spent. So every Empire class that I teach, which is an investment Empire class that is the second Thursday of every month, I talk about the fact that you have to have an A team. You have to have those people that you can rely on so that you can make judgments quickly and support your clients, or as an investor, jump in and take advantage of an opportunity when you see it. The same goes true in markets such as this, and really any market. Who is your A team? I have corrected so many lenders in the last several weeks. I've had agents say to me, "My lender said this." I'm like, no, that's not right. And yes, you can do that. All the things. We had a lot of lenders that were doing refinances only. Now they're moving into purchases, and they're coming out and they're trying to woo you with tickets or drink tabs. We're doing it with the knowledge so that you can continue to support your clients. And I know Megan and I say this faithfully. We love our jobs. We love doing what we do. We love supporting you, but we do hope that it has earned kind of a name on your list, an opportunity to support your clients on their loans, and an opportunity to support them at the closing table with First American Title and Megan Aller specifically.
Our job is to help make sure that you guys are in the know with what's happening in real estate. We hope that if we can help you better advise your buyers and sellers, that in turn that you'll send us the business so that we have the opportunity to close them and to work on their loans and to handle their transactions, because we've put in the effort and the work to help make sure that you guys are getting to the closing table.
Yes.
We want it to be at our closing tables.
We do. And we do. And that's honestly, everybody jokes about it, but it is a commission job. You know that. It keeps the lights on. It allows us to continue to provide this kind of level of service, as well as the information that we share on a weekly basis.
Yeah, so it's such a grind to put together. Yesterday afternoon rolled around. It was like, oh my gosh, here it is. It's Wednesday afternoon. It's time to get ready for the reports again. So yes, it's a grind, and we love doing it every week for you guys.
So with that, my gosh, what do we see last week? What are you expecting to have happen at the end of this month? So where are we going with real estate this week?
So we already had a question that popped up into the question and answer box. And so it says, how do you respond when someone asks how the market is doing or says that it's an interesting real estate market? Well, it is. You have to acknowledge the fact that our market is shifting. And so what I usually end up saying is that there's a great opportunity for buyers right now. And this is the market that we've been praying for 2 years, where we could get onto a more level playing field between buyers and sellers. There's actual negotiation that's happening right now where you don't have to give away your firstborn child.
Yes.
And so this is something that we've needed and that's been necessary, and it's a healthy market correction that we're looking at right now. Even though we've watched home prices fall back for the last 4 months consecutively, we're still up 12.5% in terms of appreciation that we gained so far in 2022. And so it's been a really great real estate market, and it's still better than the alternative of paying rent is to have a house. And so I would still say that the opportunity is very great, and it's really improved for those people that need to buy and sell in this market. First time home buyers. And again, you are not married to the rate. We're looking at those rates likely falling in the reasonably near future. Well, people will be able to refinance, and there are creative loan products around what's happening in our real estate market right now to help buy down that rate so that you're not stuck at that 7% interest rate.
Exactly. And to add to that, some of the things that we talk about is the fact that, and you said this, I think you even said it last week, that this isn't day trading, right? And I know that real estate is long-term. So when you're talking to a buyer right now who might be fearful of the market, first, you have to have empathy. You have to know that you can't talk someone into buying. It is a massively big investment. But what you can do is educate with facts. And you can talk about the fact that, interestingly enough, a report just came out this morning talking about delinquencies being down, even 1 month being late, 90 days being late, all down, foreclosure starts down. The housing market continues to be strong. When we see interest rates drop, and they will, but from what to what, when we see interest rates drop, we will see some of this pent up demand come back in the market. Plus, demographics have literally been on our side and they're waiting to jump in. When that happens, you're going to see some of those same homes that you thought they'd be there forever and you could jump on them when the prices went down even lower, are going to start to turn around and go back up again because more demand will come out based on the lower interest rates. In fact, I have a chart later on in the slide deck showing that even with these higher interest rates, because people are able to take advantage of some of these lower prices, you're actually getting a better monthly payment right now with a higher interest rate. Then imagine what you'd get if you refinance into a lower rate. Real estate is not short-term, it's long-term, and a couple of months trying to time the market could just kick you out of it altogether, not allowing you to have the long-term benefits that only real estate gives you.
Mm-hmm. Exactly. And so with that, should we jump into some of the weekly numbers? All right. There's already some more Q&A that are popping up. You guys are active. So just a couple of comments of people learning so much. So thank you so much for that. You guys are the best. Of course we are, because we work super hard at this. Thank you so much. And so thank you all for all of your nice comments. Let me clear those off. And so can you elaborate more on prices falling back, but still having 12% appreciation in 2022? And so we had such a rapid fire start to the year that we ended up seeing that there was nearly 18% appreciation, 19% appreciation, just in the first 3 to 4 months of the year, where we were seeing average close to list price ratios going up to 107, 108% of their last asking price. And so all of those multiple offers that we saw early this year really drove our home prices up early in 2022. And you typically have a seasonal pullback from July through September, where home prices end up falling on average 3 to 5%. They've actually fallen about 9.4% so far this year. And so we've had 4 months of consecutive loss, but it's not enough to offset the amount of appreciation that we gained just in the first 4 months of the year.
So you are talking about the fact of if you bought in March or April, right before the buying season started to pull back because of those higher interest rates. So that person might have lost some value, but the people that bought in 2020, 2021, or before that had substantial gain that they're giving a little bit of it back. I mean, we gained almost 44% here in the Denver market during the pandemic. So to give some of that back is okay. Those are unrealized gains. Yes, the people that just bought could be slightly underwater if they put no money down, they did a down payment assistance or a VA. But again, they're not selling. They just bought in March. They're not going to turn around and sell now. They're going to hold that for the long run, and their appreciation and their values will go up. Real estate always goes up. It's just a matter of time. So that's where that slight slide back nationwide, CoreLogic is coming out, or just came out with a report saying they're expecting 9% national appreciation. Our appreciation will still be strong for the year.
Still strong for the year. You just got 2 new buyers referred to you, so that's wonderful.
Margaret, thank you.
And then please advise which report was about foreclosures and late payments are down.
So I can actually put those in the email. So it was CoreLogic just came out with a report. FHFA just came out with their report, and those FHFA is Fannie Mae and Freddie Mac. So several reports just came out. And then we also see Black Knight comes out with a report each month showing the drop in foreclosure starts. And that the foreclosure starts was Black Knight. The down in late payments was FHFA or Freddie Mac.
Awesome. Let's go ahead and hop into the numbers. We had about 10 minutes of extra time that was going on. And so we'll go ahead and get this going. And so let's see, let me make sure I get the right report up here. So looking at the numbers for this week, we were looking at, well, I've been getting a lot of questions about how am I going to put together projections for next year? And the only year that I can really attune to what is similar to 2022 and what I expect to see for 2023 is looking back to 2019. And so I think that when I go through and put together projections for next year, I'm going to kick out 2020, 2021, and 2022 because they just don't make sense to compare in this market. Getting back to our more historical levels of for the last 9 to 10 years where we've seen about a 2-month supply of inventory, looking at 2013 through 2019 with a more fine-tooth comb. We're looking at our strategy sheets going into next year. If you're looking at listing, I have a lot of people asking me, should I wait and list until next year? Should I go ahead and list now? And it all depends. If there's someone who's looking to buy in this market, I would say list now and make your purchase now because you're going to have a much more seamless transaction than if you wait until the spring. But I expect the spring to pick back up again with the bulk of our transactions happening March, April, and May, where our strategy sheets turn more red as we look through those columns with target closing months of April, May, and June. And so I expect there to be a slower start as we look at the beginning of January and February next year, where we're not going to come out of the gate like we did in the last 3 years. And so I think the market's going to slow down. We may even see negative appreciation for the first few months, just because we had such sensational numbers that happened in 2022. Looking at our strategy sheets overall by week, looking at these numbers, it's been interesting to see that it's continued to cool off in our marketplace, and that trend continues through the end of the year. So we expect there to be fewer of those transactions that are happening as we get into the later parts of 2022. Our month supply of inventory held fast this week at about 2 months worth of inventory. So for every one buyer in the market, they had about 2 homes to choose from. That's still considered to be extreme seller's market territory.
Right.
And so
Right.
it's not the extreme sellers market that we saw earlier this year, where we had 2/10 of a month of inventory. That was unhealthy and unstable for us to go through. But having a 2-month supply of inventory is now getting us back to where we were from 2013 through 2019, having about that 2-month supply of inventory. And we're basically right on base with where we should be for the month of October based on that data from 2013 through 2019. Our average daily active count only, oh, go ahead.
Looking at this chart though, it looks extreme.
It looks
and it looks
extreme.
high, right? I mean, that's the perspective. I just wanted, because you said that. You said, you're going to remove 2020, 2021. But these are the visuals, guys, that people are seeing right now. And the very visuals that we're saying does not say that it's in the seller's market. You have to extend.
Yes.
Right?
And so maybe what we'll do next week is we'll go over the monthly report. I'll try to get out. I won't be able to get it out next week. I'll be able to get it out the week after that. But we'll take a more historical look at what's happened in the marketplace so that we can have some better ideas to set that expectation going into 2023. Average daily active count was up by about 1%. We had 7,151 available units for sale. Back on markets with a little pop of activity, up by 3.7%. Again, our fallout rate is about 8 to 9% for our fallout rate for units going under contract and then coming back on the market. Little pop of activity last week with pending transactions going up by 2.1%. But what's interesting is that it's down 43.9% from where we were 1 year ago. So there are definitely fewer transactions to be had out there in the marketplace right now. Closed transactions year over year off by 44.9%. So we've got a lot less transactions that are happening, which is why you have to sharpen your saw and be on your game as to why now is a good time to buy or sell real estate by using facts and not fear, because there's a lot of fear mongering going on in the headlines right now. Looking at the news, and I'm getting past articles on a consistent basis where the headline is sensational, but when you take a deeper dive into what the article is actually saying, it's not bad.
Right.
But those headlines, those are what we read.
They'll
and
grab
so
you.
that's what people grab onto. The odds of selling ended up dropping down to 45.2%. Usually for the month of October, we're sitting at about a 50% odds of selling. And so if you list a home in the next 30-day period based off of what went under contract last week and our current levels of inventory, we're looking at about 45.2% odds of selling. Historically, the odds of selling ends up going up just a percent or two as we go into October, November, and December. But what I'm waiting for is our big purge of expired and withdrawn transactions. And I haven't seen the big purge yet. Sellers that are listed this year really want to sell this year. They're sticking in the market and they are not going under contract, and they're hanging out on the market, allowing our inventory to age in place, which is bumping up our inventory levels across Metro Denver. And so the odds of selling is down to about 45.2% right now, which is back to where we were pre-pandemic levels. Looking again back to about 2019 is what we were looking at.
This is the opportunity for buyers.
This
What
is
you
the
just said.
opportunity
I mean,
for
they
buyers.
want to sell this year.
Yes.
So we've got to go in with a strong offer.
Uh-huh.
Use some of the things that we're going to talk about in the second half, the 2-1 buy down and such, but holding on to these data points right here is so important to speaking with our clients right now.
Yes, absolutely. Looking at where we should be for a balanced market based off of what went under contract last week, we should be closer to about 22,000 available homes for sale in our marketplace. So we're sitting at about 33.2% of a balanced market. To get us up to an average or a normal market, we would need to have about 15 to 18,000 available listings for sale for us to feel like some sort of normalcy in our marketplace, which would put us between 3 to 3.5 months worth of inventory. But for us to truly flip into a buyer's market, we need to have 66% more homes on the market than what we have right now, based off of the current levels of demand. Showings continued to taper off this week. They were down by about 1.6% with about 10,500 total showings that were set in the last week. That was about 1.5 shows per property per week. And I've been getting a lot of questions again about when to make price reductions, and you don't want to make price reductions too soon because it's taking patience in this market. And so if you're not averaging 1.5 showings per property per week, you may not be in the target zone for that particular listing. I'm getting a ton of calls still on Mondays asking for that showing time report to say what in that zip code and that price range, how many showings per week should they have gotten, and if other people are getting showings or not, because it doesn't always mean that you need to make a price reduction to get more showings. It could just mean that that particular zip code and price range is slower overall, and you need to exercise your patience. We were looking at about 13 showings to go under contract this last week. So if you're getting about 1.5 to 2 showings per property per week, that means that you could be on the market for as long as 6 weeks before you guys go under contract. So if you've had a total of 13 showings and no offers, it may be time to make a price reduction at that point. We looked at median days on market for pending transactions this last week, and it was 21 median days on market, fell by 1 day this week. So a little bit quicker than what we had seen in the weeks past, but we're hovering around that 17 to 20 mark for median days on market right now. Price reductions took a little bit of a dip. Last week, we were over 50% of all the homes that went under contract made a price reduction. This week, it was 49.9% of everything that went under contract made a price reduction. Average price reduction was about 7.7%, which is down from the 8% price reduction that we saw last week. Last week was the highest price reductions that we had seen all year long. Well, in a long time. It was back to 2012 when I measured that for how high those price reductions were, but it was about a 7.7% price reduction from the original price, or about $57,000 off of the original price. Up to $500,000, we're still looking at a cooling market overall. We had about 1,800, 1,900 total available homes for sale in our marketplace, 307 new listings. So our new listing activity is starting to dwindle, which typically happens as we get closer to the holiday time, where people choose to wait until spring to list their home rather than going on the market. Month supply of inventory popped up by about 1/10 of a month. So we were sitting at about 1.4 months worth of inventory. So we're out of multiple offer territory for this particular price range as well. Closed transactions in the under $500,000 range are off by about 50% from where we were 1 year ago. So definitely fewer transactions going around in the under $500,000 market. The odds of selling was still 54.4%. It fell by 1.9% week over week. We'll see if we have that big purge of expired listings every time we go through the end of a month cycle, and I'll have more information about this hopefully next week. But every time we go through the end of a month, the way that you guys write your listing contracts is they're set to expire or withdraw at the end of the month. And so hopefully what we'll see is that big purge of expired and withdrawn transactions that will help stabilize our market and stop that month supply of inventory from going up so that we stay in extreme sellers market territory. Percent of balance, we still only have 22.6% of the inventory required to offset demand. In this market, we need to have about 8,000 homes available for sale. So I'm not looking for a market correction in this under $500,000 market. We were getting about 2.2 shows per property per week with about 4,000 total showings that were set in this market. So if you didn't get 2 showings on your listing under $500,000, it may be time, that might be strike one to consider a price reduction. We're also looking at about 13 showings to go under contract. So if we're looking at about 2.2 shows per property per week and about 13 showings to go under contract, again, that's about 6.5 weeks on the market for you to go under contract at the current rate of sales. Median days on market popped down from 21.5 last week down to 16 median days on market. We've been hovering around that 15 to 16 median days on market now for about the last 4 to 6 weeks. And so I would say that that's probably a pretty good benchmark for you. So if you've been on the market longer than 16 days, you're in the bottom half of the pack, and it may be time to consider a price reduction at that point. Price reductions ended up coming down by about 10% this last week. We were sitting at about 42% of all the listings that went under contract last week made a price reduction, but the larger price reduction did end up coming through where it was about an 8.4% price reduction, or about $38,500 off of the original price for homes that were under $500,000. $500,000 to $1 million is really our largest price point. This is about 60.2% of all of our housing inventory in Metro Denver. You can see the cooling trend continue to settle in as we get deeper into the fourth quarter. We're now looking at about 2.3 months worth of inventory, which is up from the 2.1 months worth of inventory that we've seen over the last couple of weeks. But here's our active line here, and you can see that number is starting to stabilize, where we're not seeing as many new listings come on market. New listing activity was actually down week over week by about 17.8%, with an average daily active count of about 4,200 available homes for sale. Pending transactions came up by 0.5%, with 430 units going under contract. Closed transactions were down by about 2.9%. You can see in this market year over year, we're down by about 40% for pending and closed transactions. The odds of selling dropped by about 0.7%. So we were looking at about a 43% odds of selling. So if you put up a new listing, if it's going to go under contract in the first 30-day period, you've got about a 43% chance of that happening right now. For percent of balance, we're trending closer towards balance in this market than any other market that we're currently looking at. This is our most interest rate sensitive category, with about 90% of borrowers requiring financing to get into a home. So they're very conscientious of what's been happening with interest rates. But interest rates took a nice little dip this last week. So that's kind of some good information.
Yes.
Percent of balance, we're sitting at about 37.9% of balance. We would need to have about 11,000 total units available for sale in our market for 500 to $1 million. We were looking at about 1.3 shows per property per week in this price range, with about 12 showings to go under contract. So again, prepping your sellers that you could be on the market for about a month and a half before you're going under contract in this market. Median days on market stretched out. We added 4 extra median days on market this week. We're now looking at 27 median days on market. And so that number has been slowly climbing as we've watched interest rates go up. So homes are definitely hanging out on the market a little bit more. We saw that 55% of what went under contract last week made price reductions. And the average price reduction this last week was 7.2%, which is down from the 8.2% that we saw last week. But that's about a $53,000 price reduction in this $500,000 to $1 million price point. The last time that we saw price reductions on this scale was back in 2012. And so again, we're seeing much larger price reductions that are happening right now. 1.5 to 2 million cooling trend continues to settle in as we get deeper into the fourth quarter, but our month supply of inventory came down by 2.2%. Pending transactions actually jumped 50% this last week. And so we put 57 units under contract that were between 1 and 1.5 million. Our average daily active count is about 550 available homes for sale in this particular market. Our pending transactions were only off by 6.6% from where we were 1 year ago, but closed transactions are off by about 53%. So again, fewer transactions to be had. The odds of selling was 37.2%, which is still better than where we were back in the pandemic. So this area is actually doing well. They're less interest rate sensitive as we go up in price. Right. And so they're not reacting to the markets quite as much as lower price points are. In this market, we would need to have about 2,200 available homes for sale. So in this market, we only have 24.8% of the inventory required to offset demand. Shows per property per week, we were looking at about 1.3 shows per property per week, with about 738 total showings that were set last week for $1 to $1.5 million. And we're again looking at about 13 showings to go under contract. I probably need to go through and clean up this graph a little bit. There's a lot going on here.
There's a lot going on.
Yeah, there is. There's a lot going on. I need to remove some of the labeling because it's just getting to be excessive. I didn't think that we'd be doing this for as long as we have been. So I wasn't
and every week.
Right. And so it just tacks on and makes a big messy graph. Yes. But we were looking at about 12.9 shows or 13 showings to go under contract. So if you've had a total of 13 showings and no offers, it's probably time to make a price reduction. Median days on market popped up a little bit this last week. We went from about 11 to 15 15 to 25 median days on market. So some of that aging inventory was absorbed into the market earlier this week. And with those homes hanging out on the market a little bit longer, the likelihood of price reductions went up the longer that you stay on the market. So it was 45.3% of what went under contract thus last week made price reductions. And the average price reduction was about 7.1%, which is up from the 5.6% that we saw last week, or about $98,000 was off of the original asking price. Last price range that we'll talk about, and this only covers 2.8% of our overall market, between $1.5 to $2 million. Looking at our cooling trend, again, it's really started to settle in as we get into the fourth quarter. Month supply of inventory is now sitting at about 2.8 months worth of inventory, which is not bad for the $1.5 to $2 million mark. I like to talk about this because I did a presentation for the Colorado Association of Realtors for their annual convention back in October of 2007. This number was 12 and a half years worth of inventory.
In this price point?
In this price point
Yes.
for the around $2 million price point. It was 12 and a half years worth of inventory. So we only have 2.8 months worth of inventory. This is a really solid number for the $1.5 to $2 million price point. And it came down from 3.3 months worth of inventory that we saw earlier. We have about 204 active units in this particular price point. We put about 17 units under contract. That number came up by 21.4% from where we were 1 year ago, 13.3% up from where we were 1 year ago, but our closed transactions are off by about 25% from the same week 1 year ago. Looking at the odds of selling, it's 36.3%, still far better than where we were back in the pandemic. Again, looking back at 2019 numbers is what I'm really looking at for a good comparison. In this market, we would need to have 887 total units for a balanced market. So we're only sitting at 23% of our balanced market. We have about one show per property per week for homes between 1.5 to 2 million, and about 12.5 showings should go under contract. That 12 to 13 showings to go under contract is the same number across the board for all homes up to $2 million. So that's a really good benchmark for you guys to be using. It's been very consistent. And so I would recommend that you really watch what's happening with your showing activity. We saw 35 median days on market, which is down from the 40 median days on market that we were looking at just last week. So some of that aging inventory, some of those properties are getting picked back up. But we did see that 64.7% ended up making price reductions last week, with an average price reduction of about 12.4%, or about $273,000 off of their original asking price. So we did see larger price reductions that happened just this last week. And so again, it's been interesting to watch the twists and the turns. Hopefully we're going to see that big purge of expired and withdrawn transactions as we go through the next couple of weeks as people get closer to the holiday season. So it drives down our active inventory and it stabilizes our market. We had a couple of questions that we should answer. So let's go ahead and pop in here. We got 4 of them hanging out. I have a seller that I've been trying to get to market this fall. They couldn't get the home ready and now want to list beginning of November, but should I wait until mid-January? Usually I always tell my clients to wait, but in this market, not sure if rates will be even higher. I think that's a great question for Nicole.
So the answer is we don't know. And the answer is I'd love to know, right? I mean, here's the deal. I think that our January and February is going to look very similar to our October, November, and December. I think it's going to start to break free later, like more like spring. There's some things that happened today, but I don't think that today is a trend. I think today is a blip. We've got PCE tomorrow. So I'm not sure interest rates they'll still be volatile. We could see interest rates at 5.5 next year. I don't think it's going to be as early as January.
I don't think we're going to have that straight out of the gun. I don't think that's going to happen. Updates on broker-based showing data, none. It is impossible to try and pull that data out of there.
Just throw that one out.
And so it's about 10% of the overall listings are being set through showing time. So I'm off by a factor of about 10% in terms of showing data, but the vast majority are still using showing time. And so I would still benchmark my numbers on those showing time numbers. Compared to last year, would you say that we're down 50% on the active buyers in the market? Mortgage applications down?
Mortgage applications continue to go down. They're down 3% week over week. So those continue to slow down. To say 50%, they're down at mortgage purchase applications year over year are down around just under 50%.
What is the best time in the new year, spring to list for that 1.5 to $2 million market? I would call it March at this
I would
point.
too.
Is probably going to be your best bet for listing in that time where we see the highest and the best odds of selling for those properties that are listed earlier in March. What percentage of homes were making price reductions in the $1 to $1.5 million market? I'd have to go back and check.
Oh,
I will
shoot.
email it out to you, but I
Yeah.
want to say that it was like 45% if my memory serves me correctly.
Sorry, I did that.
I'm
I should
I'm
have.
not sure.
Yeah.
I'm not sure. I'll send it out to you in an email. And Nicole, are you expecting rate changes after the Fed meeting on the 2nd?
Only if they don't do 0.75. So if they do less, which just read that Canada actually did that, where they did, oh shoot, now it might not be Canada, so I apologize. But I just read somewhere that they were going to do 0.75 and they did 0.5 instead. If we do the same thing, it is going to benefit interest rates, because then we're going to think, okay, they've got inflation under control. We could see a blip with that. I don't expect that. I really expect the Fed to do 0.75% on November 2nd and then 0.5% in December.
Mm-hmm. What would you tell buyers who seem to be very picky on acceptable properties? Well, it's hard because they don't have their feet to the fire.
Yes.
Like they did earlier this year, where they were willing to accept those properties in any condition. But if they're going to be picky on their properties, now's the time of the season where they can actually have the ability to do that and to negotiate those inspection items. But again, not to focus on some of the more cosmetic aspects of the property, like the paint color or the interior or the decor, but more so focus on the property and what they're trying to get. But this is a market where they have the opportunity to be pickier.
Yeah. And honestly, it's picky defined by who, so buyers were buying the homes on the busy streets next to the grocery store because it was scarcity. And now they have the luxury of time and choice. Now, the luxury of time and choice, as I'm listening to your numbers, that we're still squarely in a seller's market. We still have 75% of the homes that have financing locked in under 4%. Mm-hmm. We have incredibly low, if not actually decreasing, foreclosure starts and delinquencies. So I'm looking at a market where you're not going to see a ton of movement just because, right? I mean, that kind of has passed. So unless somebody has a reason to move, we're going to go into the spring season with relatively limited inventory. So they've got choice right now, and I would allow them that choice. At the same time, you don't want to be overly picky. Could it make a great rental in a year? Could you sacrifice a little bit today for tomorrow? Otherwise, they're gonna bank on that luxury of time and that they haven't had for 2 years. I would be, and it was Canada. I was like, I think it's Canada. And then I started to think that I was also reading about the European Central Bank this morning. There's so much news going on. In fact, I have the article still sitting next to us where we were looking at the economists and how they were just bashing the housing market. When you actually read it, it was based on what's happening in Canada, in Sweden, in Japan, and China right now, more so even than the United States. We are relatively cushioned. One of the things that I picked out in that article is Sweden is on a 2-year mortgage cycle. So you can't be locked in for 30 years like we can. All of those people are making their payments because they have a 2.6 interest rate. They can. And wages have been going up. Nobody's talking about that. I get affordability is tight, but wages have been going up and they're locked in for 30 years. It's not going to flip on them like a 2-year arm like we have in other countries. So with that, I'm going to start the presentation.
Let's do it.
All right.
Yeah, we're right on the dot, 10:33.
All right. Okay. So, as we get started, we always just start out with our quote. We'll move on from there. I have some very lending specific things that I want to make sure that you guys are keeping in your toolbox, right? You need to know what opportunities you have when working with buyers, even working with sellers. How can we make our sale more aggressive? How can we make our buyers more competitive? Because we're seeing, even in a good listing price right and stage well, multiple bids are happening and we're seeing it for over asking. Yet on the flip side of that, we're seeing homes that are dropping by 50,000, 100,000. So both of those are present. So how are you supporting both? So I want to go through a few slides with lending specific ideas. And then we're going to jump into a little bit about what the economy is doing, the GDP, interest rates, so that especially going into this weekend, do your buyers have a little bit of an advantage? And they do. So the next big thing, we started our big push. We sent out a blast. I know I've kind of mentioned it a couple of times. We've got all of the speakers lined up, nailed down. We are officially starting the ticket sales. We have a ton of great sponsors. So starting on our speakers, I mean, we've got Lee Brown, who's a I can't talk.
Yep. Yikes.
Podcast.
Take a sip of coffee.
I know. I was like, la, 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 la. A podcast host. There you go. Crazy shit in real estate. Super excited. If you have not signed up or if you like to listen to podcasts, you absolutely should subscribe to her Crazy Shit in Real Estate. We've got Eric Wall. He will be painting 2 pictures for us during the event, which is really fantastic. He's a phenomenal motivational speaker. Renee Rodriguez, if you have not heard him, Molly Bloom, just off the charts, the speakers, the lineup. And this is just before noon.
Mm-hmm.
It's
a packed day.
It is packed.
Great.
Go to bed early the night before on February 1st, because I promise you, I will exhaust you on February 2nd. That's the goal. So let's jump into assumable loans, because I want to make sure there's a lot of conversation with interest rates, with home prices going down, interest rates going up still. Even if we have a day like today, we have the volatility where you have a seller who might have a government-backed loan with a lower interest rate, and it might be time to negotiate that. Now, for the last year, 2 years, I've said everybody's talking about assumable loans and nobody should be talking about assumable loans. Like it's a lost cause. And the reason that I've been saying that in the last 2 years is because the buyer has to bring the difference. We've seen so much appreciation that any buyer that wanted to take advantage of that low interest rate could just buy down the rate because they have to bring so much more. Because if you're selling that home, originally it cost them $450, now they're selling it for $700. That loan amount is $400. That's the assumable part. So now I've got to bring $300,000 to the closing table. That's the biggest hiccup with assumable loans. The number 2 hiccup is the fact that you have to work with that lender. You can't choose your lender. You have to go to the lender that holds the note. The other thing is most loans were refinanced in the last couple of years. Mm-hmm. And they probably got out of that government-backed loan and got into a conventional loan because they had so much equity and took advantage of these low interest rates. So you're just going to have fewer of them as opportunities. But here's a couple of highlights really quickly. VA, assumable, absolutely. You only have a 0.5% funding fee, so that's actually really low. The kicker is you can actually sell the home to a non-veteran, somebody who does not have VA eligibility, but you will still be on the hook. The seller, your eligibility is still locked up in that home when you go to buy the next home, or if that new buyer defaults, it's going to come back on your eligibility. So I'd think long and hard, and personally, I wouldn't do it. FHA also assumable. You don't have that big upfront mortgage insurance, but you have monthly mortgage insurance for the life of the loan. Where you might find a deal is somebody who bought their home, never refinanced out of the loan that they got before July 3rd, 2013. I sure hope that they did.
Yeah,
I sure hope
no
that they
kidding.
did. But if those loans still exist, those loans do drop off. The mortgage insurance drops off as soon as you get to 78% loan to value. That's what the rules were before. But they have some restrictions, a debt to income ratio of 43% and a 600 FICO. USDA also assumable, low monthly mortgage insurance, the upfront mortgage insurance is waived. So all of these are really fantastic to know, to ask, spark a conversation, who knows, create a video. Jeremy Kane just did that yesterday. Inform your buyers and sellers of the opportunities, whether or not it helps them. It's an opportunity to educate and to stay relevant. So conventional jumbos, no, not an option. Because more FHA and VA buyers are coming to market, and as well as the down payment assistance options that we have available, we did throw together a quick appraisal cheat sheet. So we sent this out to a couple of real estate agents who had requested it. If you want that, we do have a ton of tools and marketing collateral that you can use, keeping it in your book, handing it out, posting it on social media, informing your sphere on what options are available. So not only do we have this quick, kind of more of a social post, but I also have a 4-page stop, like here's the alerts. These are the things that you got to look for. 4 pages of all the things that you're going to want to know when you're working with an FHA buyer or as a seller. If you want to accept FHA, you'll be able to do a quick rundown of the house. So if you want that, we'll probably put that up on our Agent Ignite Facebook group so that you can download that at your convenience. We are still doing the lease buyout program. absolutely something that you need to have access to, something that you need to be talking to your clients about, because renting, although the acceleration of rent is slowing down, it's still high. And we keep saying it's 100% interest rate. You're not building anything. You're just waiting for what? I'm having a lot of these conversations. I'm waiting. I'm like, what are you waiting for? I'd love to know so that I can be on the watch for it too, right? Let's go through this market together. Let me make sure that I'm your advisor, your guide. Let me be on the lookout. What are you waiting for? Because I wanted to hear the answer to that question.
I know. Yeah.
So the lease buyout program, we cannot do this with the down payment assistance programs, but if you're able to use a down payment assistance program, that is phenomenal because it's going to give you a lot of cash. Or if you don't want to use that, maybe you make too much income, the lease buyout program is something that we can help those buyers get off the fence and out of renting. So fantastic. We also put this together on Saturday, a verbose 3-2-1 and 2-1 buy down. It was verbose. Right there.
I love it.
I can't say
the thesaurus today.
I can't say podcast, but I can say verbose. Whatever. So we've got the 3-2-1. I wrote up a whole thing. It's on our blog. It's in Agent Ignite. It was on social media. Here's all the things that you need to know, what it means, how you do it, how it's calculated. Some of the quick points on this, though, I do want to point out. Buyers can contribute. Another thing I had to correct other lenders for. Why would a buyer contribute is the question. A buyer's not going to put their own money into an escrow account because a 3-2-1 buy down is simply an escrow account held by the lender or the servicer that uses a little bit of that escrow account every single month to pay down the mortgage payment to make it feel like it's a lower interest rate. It's never a lower interest rate. It's locked on a 30-year fix at the original interest rate, but it feels like a lower interest rate. So that escrow account is not gaining you any interest. If you're a buyer and you're wanting to do this, don't do it. Put your money in a 1-year treasury or anything else for that matter right now. Any savings account is making more money. Because somebody asked me, and I love the questions, can we do it on a refinance? That was a brilliant question. You wouldn't want to. Put the money in a 1-year treasury. You're going to get over 4.5, especially if you do it right after the November 2nd Fed rate increase. So buyers can contribute though, because maybe the seller's contributing 12,000, but I need 13,000 or I need 12.5. The buyer can give the rest. Those monies are held in an escrow account. Any monies left over, because I hope you all refinance in the next year, right? Or worst case scenario, next 18 months. When you refinance, any monies in that account will be used as a principal reduction and aid to your balance. So you don't lose a single penny of that money, of that seller credit. So, and where do you put it? I've been asked that a number of times in section 4.2, but I'd also suggest adding it to additional provisions. I'm not a contract writer, you guys are, but that's where I've been seeing it. We also have, this is a flyer, and then we have an Excel spreadsheet that you can download from Agent Ignite. All you fill in is the blue fields, it calculates the rest. You can show it to your seller specifically for that particular property. We've been doing a lot of property specific ones, as well as videos for those sellers or those buyers of that listing. We are also doing the refinance certificate still. And in fact, I extended it because I can't help myself. I just keep wanting to give away money, I guess. So now we're saying we're waiving the lender fees. You're going to save over $1,500. Hold on to this. It's good through 2024. I really think it's going to hit in the middle of next year. You have to hold the loan at least 6 months in order to do this, and you have to have purchased through us. So we'll make sure we'll have all of these on in our database as well. It's not like you got to hold on to the certificate, but it is a nice to have. We will sign it, and everybody that purchased with us post-March with those higher interest rates will get a discount on their lender fees, because we want everybody to be better,
Yes,
right?
of
It's
course.
not about more business.
Doing the right thing.
It's about doing the right thing.
Mhm.
I want everyone, because it is going to turn around. And then the last thing specifically on lending, a number of people reached out to me asking me, what does this mean? If we're moving away from the classic FICO model, which is the old credit scoring model specifically for home buying, what does this mean? Is this good news? Is this bad news? Do I care? right? Because that's the question I ask all the time about everything I read. Do I care?
Mhm.
So do I care? You kind of do. And it's the nuance in this that you care about. So interesting, they're trying to add, so FHFA, we've known this since we had the whole turn of administration, that the current administration is really hyper-focused on getting the lower income earners into home ownership. So they're doing everything that they can to lower the LLPAs, which is the loan level price adjustments, specifically for lower price points, lower credit scores, lower down payments. Those people are going to get opportunities on the backs of high balance loans, second homes, investment properties. We're going to see some of those loans might have higher LLPAs, while these more affordability type loans are going to have lower LLPAs. This is kind of going towards that same thought where we're trying to make it more available to get into home ownership if you don't have access, because maybe you don't have a credit score, but they're relying on landlords, utilities, services to upload credit data so that they can get a credit score. It's going to take a long time to get that done. Landlords are not going to go run in to record all of your on-time payments. So trying to get those people to do it. Here's the thing that I'm actually a little bit more excited about is that right now we have to use all three, TransUnion, Experian, and Equifax. It's going to a dual, so only 2 bureaus, which there's still going to be 3 in existence. We might find some opportunities where we want to specifically exclude one, and or they're going to get more competitive on their accuracy and on updating their data. So that's a good thing and could end up costing less to the consumer. All good things. We love competition. All right, let's go into a couple of things that are happening in the economy. So the GDP just came out this morning. We saw the GDP advance. This is a first look of 3. So remember, we're not done yet. It's probably going to go down. So the markets rallied. Why? Stock markets and bonds. They rallied on this idea that, and it's really not the GDP that went up higher than it was expected, because it was expected to be 2.4. It went to 2.6. And remember, this is after 2 quarters, consecutive quarters of GDP decline, where people were debating whether or not we were in a recession. Now, the White House is probably going to take a stand saying we were never in one and we're not in one, and this isn't a recession.
And they're going to do it just like this.
They're going to do it just like that. And they're going to go, good job.
Yeah.
And if they do that, well, good for them. It's going to last a very short period of time, because I do think that we're heading into a recession. Some of the things that are propping this up is the fact that the consumers are still spending. The problem is they're pulling it out of savings and they're putting it on credit cards. We are seeing some benefits to labor, but so small that it's not really helping us yet. Durable goods and business investments were still down. So when businesses aren't reinvesting in themselves, you're still going to see a drag on the economy. And that came out with the PMI numbers as well earlier this week. Those numbers actually moved into a recessionary status. And so we're expecting that recession to happen. A lot of the economists that I read are all thinking it's going to happen in the first half of next year, which is why we're all thinking that the rates are going to drop in the middle of the year, giving us all a better second half of the year. This is why it is so important to not hide under your covers.
Yes.
Right?
Yeah.
You got to keep at it. You've got to stay relevant. You have to stay communicative. Don't push your clients. They don't like that. You have to just educate, support, and when they're ready, be there to support them, right? To be available and make sure that you're providing them that information. Initial jobless claims came out. It increased 3,000. A very small increase. Where we're actually seeing more of the increase is in the continued claims. So what that means is employers are holding on to their employees. It took them a long time to get them, right? I mean, there are more job openings than there are people looking for jobs. So they're holding on to them. They're not releasing them, but the people that are on unemployment are staying on unemployment for longer. So it means that we're seeing job freezes, which always happens before you see more layoffs. But we're seeing businesses close. And of course, we know the real estate market has hit this gone into a recession already before the rest of the economy. I know we're seeing some lenders. I'm sure we're going to see some title companies. I know we're seeing some real estate companies all either doing massive layoffs or even some of them closing their doors. So we will see this number pick up, but right now it's showing the resilience of the economy. Why is that important? Because when we see days like today, where we see interest rates drop, we jump on those opportunities because I don't think it's over yet. I think we're still going to see volatility. We're still going resilient until we're told we can't anymore, or consumers until they simply max out their credit cards and they can't spend anymore. So we're still going to see more of this movement. The PMI I already talked about, that dropped. New orders are down. So we actually saw employment costs decrease. That's a good thing. It would usually prop this number up. We also saw that some of the supply chain issues have released. That should prop this number up, but the new orders are down enough because most of Americans have returned to services from goods. You guys are not ordering as much on Amazon. I know that because I'm not either.
Well, I am.
You're making it up for the rest of us?
I know. I had 3 deliveries the other day.
In one day?
In one day.
My husband would not be proud of you.
Everything is on Amazon.
Everything.
I'm like, just bring it to me.
So people are still spending on services. It was so funny. I went I had coffee last night very late with 2 dear friends, Val and Mike, and they just got back from Switzerland and a whole trip. I had like 3 friends in Switzerland the exact same week. Services is still being spent on. People are still spending out of their savings account. They're still putting on their credit cards, but we are seeing durable goods is down. And of course, with a strong dollar, we're also seeing that those exports are harder because other countries can't simply afford what we've got to sell. But with that, we did see this 10-year drop below 4, and I hope it stays there. It does have some room to continue to go down. I'm not expecting this to be a massive, long-lasting trend. We do have PCE coming out tomorrow, but that inflation number is the same data as the CPI earlier this month. Shouldn't move the markets too much unless it's something unexpected, which is kind of the same answer that I have for for the November 2nd Fed meeting. Unless they come out different than 0.75, which Canada did, and maybe we will, and maybe the markets will react. That would be great. I think they're going to stick with it and then just have all the reasons why they can do 0.5 in December. And I've even heard some rumors that that might be it, because they were originally talking about going all the way through March, and now they might have hit their target. So we'll see what they have to say. Of course, I will be all ears on what the conversations are November 2nd and relaying those to you. So we did see a nice little dip right back to 7.125. I was celebrating. She wasn't. She was like,
great.
Oh, it's still over 7. You know what? Take it when you can. These are the times where you have to look past the rate, look at the monthly payment, and look at the long-term opportunities when we know interest rates are going to drop at some point and refinances are easy. In fact, they're less expensive with our refinance certificate. All right. So one of the reasons why we're not seeing a massive drop, when we see the 10-year drop below 4, we're still seeing, and I've been talking about this, that secondary market. Like, I want to go look at the 10-year and go, okay, the 10 years this, the 30-year fix should be that. Typically, they have a correlation of 1.65 to 1.80. What does that look like? That's blown out. Right now, they're 3% difference. And the reason why is because of the risk. And you see that hovering around recessions or going into recessions, or a time in which you see lending standards crunch. In this case, the lending standards aren't crunching. What's happening is the secondary market is crunching. There's no buyers and the Fed's not buying. Literally, the Fed could buy mortgage-backed securities today and our rates would drop to 5.5, like that, literally. But they're not going to do it because they're trying to control inflation and they don't want you buying a house. So when the housing numbers have such a big impact on inflation, they want you just to sit still for a minute. And they know that it's causing pain. But that spread, the spread between the 10-year and the 30-year fixed, is what's keeping our interest rates high. And a lot of that has to do with the secondary markets not buying mortgage-backed securities, because they all know this is a short-term investment. You're all going to refinance in 6 to 8 months or 18 months, and I'm not going to hold this investment, and I need it for my long-term portfolio. This shows it really well. Interestingly enough, the last 3 times that spread got to 3%, it dropped. Those crunched. So we could see some of that volatility result in lower interest rates. And remember, we have the November CPI numbers coming out as a comparison to last year. This is the month we've been waiting on, because last year, this is when the CPI numbers went up. In November, we start to see the October numbers, all of this, October, November, December, January, all higher. So our numbers that come out in the beginning of November could show inflation dropping because it's a comparison. And on top of that, we're seeing durable goods go down. We're seeing supply chains free up. We're seeing all these things that also are going into that. We're seeing the cost of labor just still staying strong, but not going up at the rapid pace that it had been going up. So all of, and we're seeing rent acceleration slowing way down. We're seeing home price acceleration slowing way down. All of these things are going into inflation as well as the comparison. So we could start to see the Fed, that 10-year treasury doesn't necessarily have to drop tremendously to see a nice benefit into our 30-year fixed mortgage rates. All right, CoreLogic came out with a report. I'm gonna speed through these because they really just, the slide itself tells the tale, but CoreLogic is showing that we are slowing down. We have seen a dip. Home prices fell by nationwide by 2.4%. We're seeing a kind of a similar story here just in the last couple of months alone from June to August. Yet we're still up, and I put it down here so you can have that. We're still up 4.8% in the last 6 months alone. Most of that in the beginning, right? 13.1% over the last year, 42% since the pandemic hit. Guys, this is unrealized gains. It's not a real cost unless you just bought in January through April, and I get it, but just don't sell. The month over month has dropped pretty significantly. What I really liked about this chart is where the average year really is. And we just had nothing like average over the last couple of years. And so we're going to have these swings as we try to start to normalize. It's like the pirate ship that I've referenced a couple of times. We're swinging both ways. All of them across the board. Every metro is seeing a slowdown in price gains. All of this was in the most recent CoreLogic report. Denver is one of the 5 metros that is being talked about nationwide, that if these 5 metros were removed, the drop in home prices wouldn't be as big. So we are one of the leading price drops. I think it's just more of a, people got really excited. They really want it. They're going, they're listing high. And when they don't get those offers, they're having to drop pretty substantially. I mean, we just saw that. What was it? Almost 300,000 on the over 1.5 million.
Yes.
Yeah.
So 274.
Yeah, that's a lot of money.
That's a lot of money.
Okay. I was just double checking. It's still a lot of money. Case Shiller still thinks so. Case Shiller thinks we're going to land next year at 3.2% year-over-year appreciation. The MBA does not think it's going to be so well. They think it's going to drag to 0.7, so almost flat in 2023. They're actually thinking that we're going to see a slight negative appreciation in 2024. That's the only group that I've seen do that. But what I loved about this chart is they're also seeing 5.5 next year, even 4.5 the year after that. Why the appreciation is going to go down, I'm not really sure. It's more of that medium home prices. Maybe we're going to see more of the lower price points, but that 4.5 is really fantastic. If it actually hits, I'd be happy with 5.5. Yeah. I really don't want 3s again. I really don't. And I'm going to go on the record saying that. But when we talk about the transactions going from 5.2 million in 2021 to 3.9 in 2022 to 3.5, I mean, the purchases are going down. We all know that. We're feeling it. Some homes will never go back on the market, never be for sale. But focus on the payment, because as we're seeing the price drops and we're seeing this expectation of interest rates dropping next year, focus on the payment. So from June to September, we actually saw a nice little drop in prices. And the payment is still holding up with the interest rates. Now I say focus on the payment, you're like, but the payment just went up, Nicole. No, if interest rates drop, does that payment work for me? Does it still work for my budget? Can I communicate it in a way that it either cash flows or it works, and then I can refinance? Now you can't buy something that you're expecting to refinance. You can only buy something that works for your payment today, but don't on the swings, don't get caught up in the interest rates. Keep focusing on the payment. Does it work for my budget? And will it only get better from here? Because we're locked in on a 30-year fixed, unlike Sweden, who's on 2 years. I got this quote out of the Washington Post. I could not help it. It just came out yesterday. I may buy because the rent is just too damn high, right? As you're looking at what rents are doing, when you're talking to those renters about the 100% interest rate, I know that rents we're seeing statistically are going down, but I had to grab this just for the sake that have the conversation, because 9/10 of wisdom is being wise in time. Getting into the market right now, before interest rates do drop, before demand of demographics and all that pent up demand comes back on the market and creates a more competitive environment. It is not going to be like 2020, 2021.
No, it's not.
Thank goodness. But it is going to be much more competitive than it is today. And those are the conversations we need to keep having.
Definitely. We've got some questions that we need to get through. So when we look back to 2018 to 2019, sellers are still looking to make 500 to $1 million in the luxury without doing any work. Buyers are looking at this, which makes me feel like the luxury market has some downside. You know, I think that the luxury markets are much less sensitive to what's happening with interest rates, and we're actually more upside down on where we need to be with supply and demand in the luxury markets that are over $1 million right now, making them more insulated from any of these sorts of price drops.
Yes. Oh, I meant to drop that. Sorry.
Nope, you're good. I think it was 45.3% with a 7.1% price reduction. Thank you for that. I think that was a follow-up answer to what I was looking at earlier for when someone was asking for that particular number. What is LLPA?
A loan level price adjustment. So that's how interest rates are calculated based on a base. And then if you have a lower credit score, if you have less money down, all of those adjust the loan, the interest rate.
What is the advantage score for a 4.0 FHHA talking about?
So the Advantage score is going to be very similar to a FICO score. If you're looking at what the difference is between Vantage scores, I'm going to have to answer that offline.
What is the interest rate at today?
So we're hovering right over 7%. With these, if the 10-year continues to drop, and if we see the lenders react, we could very well be into the high sixes. I'm going to keep watching it all day long. And we have, if you guys have not signed up for our rate updates, we send out a text alert every Friday morning. So make sure to sign up for that. The number is 855-930-0377.
Awesome. And then Megan, with all the price reductions, are home being put on the market overpriced? Yes, absolutely. Yeah. And so if you're looking at using comps back from April, May, or June, you're using overpriced comps and you're not making adjustments for what the current market is bearing today. You're looking at what the market was doing 4 to 6 months ago, which is when we were in the insanity. And so yes, homes are being put on the market overpriced. And so we can definitely get average days on market down. We can get price reductions down by pricing more conservatively up front. Do you have a summary of this presentation we can share with our buyers and sellers?
We have, you write a quick little summary. I write a quick little summary, but the summary, we send out the slide decks.
Yes, we send out the slide decks and a copy of the recording. So we can go ahead and get those out to you. And I will get that out to you between 12 and 1 o'clock today. What was the rate update phone number again?
855-930-0377.
Awesome. Same question. So that takes us through everything. As always, thanks for joining us today, guys. We really appreciate you tuning in each week so that we can give you guys the current rate, the market update information, leading our market with facts and not fear.
Yes. Yes, there's so many facts that you can hold on to in these presentations, or even better yet, Megan, I know you always answer your phone because I've called you a number of times.
Yes.
I also answer my phone, and if I'm not available, my team is. Guys, if you need clarity on what the information is that day, if you need additional facts to support the conversations that you're having, then don't hesitate to reach out to us. That is what we're here for. We are not just, we're just not speakers on the data. We actually live inside the data. So please do reach out to us. All of our contact information is on the emails that we send out. It's all over social media. Let us help you and go to work for your clients.
Awesome. Thanks for tuning in, guys. We'll be back at it again next week, and look for our market updates to be sent out in about an hour. And we will thank you for your time, and we'll see you soon.
Bye-bye.